After a strong rally early in the third quarter, most gains were actually given back by the end of September. So today I want to talk about review of the third quarter, our general positioning, and also the outlook and expectations going into the end of the year. So if you've been keeping track, you'd know that stocks have been on quite a roller coaster ride here since March. Now, normally big events like banking crises or government shutdowns, that would send the market into a frenzy. But largely this year, the Magnificent Seven tech giants have been able to shake things off. But as we head into the fourth quarter, we've seen a reversion of these mega tech stocks giving back a good chunk of their outperformance, bringing down the indexes that they're so heavily weighted in. Now, a big part of this has to do with the spike in 10-year U.S. Treasury yields. They've actually soared to 16-year highs. And if you've been following this pink line on the chart, you would have observed that long-term Treasury returns have accordingly taken a dip because when rates go up, fixed income prices go down. Those new bonds now are paying a higher rate, so it isn't all bad. And this is happening because of the recent shift in sentiment that while the Fed might be done hiking rates, they will now be held higher for longer. But what's interesting here is the connection to the stock market. And that rapid ascent of yields that we saw since the summer here, it caused equities, especially the S&P 500, to pull back significantly. So much so that if you look at the equal weighted version of the S&P 500 in the yellow line, which actually gives each company an even footing rather than the market cap weighting, they're seeing it wipe away almost all of the gains for the year. Now here we're looking at the performance across asset classes, and in all of them, we are now off the year-to-date highs. So here's a broad overview of the tweaks that we made last quarter across the portfolios back during the July rally. And we aim to take the profits of winners and recalibrate our stock and bond positioning for potential changes in market trends, which we then actually saw materialize by the end of the quarter. And we did this by moving overweight US stocks with a preference for lower octane growth in mid-cap companies by trimming that outperformance that we saw in our tech exposures specifically. Then we balanced that US growth position with an increase in value exposure in Europe as the respective paths of inflation and central bank policies over there, they're starting to diverge a little bit. Now, on the bond front, we took advantage of the recent yield, or the surge in recent yields by adding to TIPS or inflation-protected bonds. Then we also enhanced the portfolio yield and moved up in overall credit quality by barbelling our short and long-term treasuries, and we rotated out of high-yield bonds. Just remember that I'm always watching things and making changes as needed, and obviously as circumstances change as well. So for the remainder of this year, much of the conversation is going to revolve around a potential recession. But why hasn't there been a recession yet, right? We've been hiking rates all the way since last year in 2022. So spending has been strong. You might have heard economic tales of doom, but let's be real. People are still shopping like they've never shopped before. And post-pandemic, our spending habits have actually shot up, even beating pre-pandemic levels. It's hard to imagine. And it's not just me talking off the cuff. See data from the St. Louis Fed here. Corporate earnings are growing. Warren Buffett once said, games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. So earnings is that playing field because it's actually what drives long-term returns and eventually higher stock prices on the scoreboard. From 2013 to 2022, despite the pandemic, earnings actually still rose about 7% a year, even in the year where we saw a bear market in stock prices like last year. Now, are we out of the danger zone when it comes to a recession? I wish I could say yes. Hopefully there's a lot of the banking crisis, everything behind us, but there's always the next cloud hanging over the market, with it now being the higher for longer narrative. But as we've seen since between March and June, we still want to be in the game because the positive jolts can be short-lived. And that said, we might be in for a few hiccups in the coming quarter, which is why it's important to stick to your game plan and remain diversified. So in wrapping up, here's a few other questions that I've received lately that, I wanted to touch on quickly here. So the death of the dollar. I'm sure we've all heard the whispers about the dollar's demise, right? Got a favorite quote from Mark Twain. He once stated that reports of my death have been greatly exaggerated. And I think the same goes for our dear dollar here. And it's far from down and out. In fact, Dollar's even stronger now than it was before the pandemic and the great financial crisis. You heard that right. Another little nugget here from Bloomberg. Over 40% of the international money transactions, which are powered by SWIFT, are still done using the good old greenback. It's the highest it's been in a decade. Politics and investing. So as the election season draws near, just remember this golden rule. Politics and investments, I think, are like oil and water, right? They just don't mix. So whether you're on Team Blue or Team Red, the market has been kind to both sides for over a century now, with very few exceptions. So try not to let your political views and how this election shakes out sway your views of the economy. Remember, the stock market only cares about one thing, and that's corporate earnings over the long run. Now, I'm not saying that everything's perfect here. It's far from it, but the news isn't always the gospel truth, right? And I think there's a lot of good happening under the radar as well. So I truly hope these insights can shed some light on the bigger picture, and always remember, I'm here for you. I'm watching things closely. If you do have any questions, thoughts, concerns, feel free to reach out anytime. Otherwise, stay the course and stay on point. Hope everybody has a great holiday season here in Q4. Take care.